Good afternoon, everyone. Thank you for joining us for today's webinar, Paycheck Protection Program and Loan Forgiveness FAQs. Almost all of the content of today's webinar is responding to the various questions that we've received during our previous webinars and other questions that we've received in between. My name is Mark Heath. I'm a partner here at McConnelly & Asbury and Director of Tax Services. With me is David Blain, also partner, and he is Director of our Entrepreneurial Services Group. If you do have any questions for us today during the webinar, please submit them through the built-in questions function in the webinar control panel. And also, there will be 3 polling questions today throughout the presentation. We're going to make sure that we get them in before our cutoff at 3 o'clock so everybody gets CPE credit. So we'll try to bring those to your attention as quickly and as easily as we can to make sure that you get them, but make sure you're looking out for them.
All right, Mark, great job. Exciting times, Mark. How about 4 webinars in 6 weeks? Just got done talking about that. How about that?
I know.
Exciting
and
stuff. We talked about
right.
protection loans, right? So, all right. Well, Mark, I think the first slide we have there is just talking a little bit, a little selfless plug for McConnelly & Asbury, a little firm overview for those on the webinar don't know a little bit about who we are as McConnelly & Asbury. We're a public accounting firm located in central Pennsylvania's Marketplace, offices in Camp Hill, Lancaster, and Bloomsburg. We are an accounting firm that provides accounting, advisory, tax assurance, consulting, and tax services. Anything from the attest side, reviews, compilations, audits, corporate, individual, partnership tax returns, and a number of different consulting practice group items such as valuation, back office accounting, and internal audit. Well, our main industries are in the affordable housing, construction, healthcare, insurance, manufacturing, and nonprofit industries. Biggest areas that we like to serve are in the family and business area, and we also do a number of employee benefit plan audits for a lot of our clients. So again, if you want to learn more about McConnelly & Asbury and our firm and our services, you can visit our website at www.macpas.com to get a little bit more information about who we are, the individuals that work in the firm, and the different services that we provide. All right. So today we're going to talk a little bit about some updates from the SBA in regards to what what has come out since our last April 30th webinar. There's been 5 or 6 different FAQs that have come out from the SBA that we're going to cover very quickly. We're also going to talk about the recent changes that have just come out from the Economic Injury Disaster Loan Program. And then the final thing is going to be that we're going to get right into these FAQs that came through our last webinar on April 30th. A lot of FAQs. We had well over 200 questions that were submitted. Mark and I and another one of our partners, Dan Sturm, who's out there in webinar land today, we want to make sure that he got a little kudos because he helped us out a little bit. And we answered all the questions and posted them up on our website. So we're going to direct you to go to our website to look at those FAQs, questions and answers when we get there. But let's go and just talk about a couple different things that have popped up so far in the past week and a half from the SBA. The SBA issued 6 new FAQ.
I'm gonna put a hold on you there, Dave. Quick. First polling question. Those of you out there, we're only a few minutes in. First polling question. Has the May 14th extension to repay PPP funds made a difference in your decision to keep or repay these funds? So we talked about in the last webinar the certification that every borrower has to make that the loan is necessary to support the ongoing operations of the business during this uncertain economic time. As we've all heard in the news, there's a few bigger organizations that probably could have survived without taking the Paycheck Protection loan. And so the Treasury was urging them to pay the funds back. They originally put a a safe harbor date of May 7th in place, so that if you just repaid the funds before May 7th, no questions asked, they'll just take your money back and everyone goes on their merry way. They have since extended that to May 14th. So now we're up to May 14th to do that. So first polling question, has the extension to May 14th made you rethink your decision in taking the loan?
Yeah, interesting that they extended that another week, Mark. It gives me the feeling that the Treasury Department did not feel like there was enough money coming back into the coffers of individuals and organizations that wanted to repay this money. So they wanted to give everybody that extra 1 week to rethink your decision.
Just in case you didn't get the notice, we're going to give you 7 more days.
Exactly.
All right. I think that's probably enough time.
So 90% of everybody said no. Doesn't really make a difference for me at all. We know we needed the money. The money's important to us to continue to operate, so we're not repaying it. Okay.
Not a huge surprise.
Exactly. All right. Well, like I said, let's just kind of get through the first couple items here real quick. Again, the SBA issued 6 different FAQs in the past week and a half or so, and we're just going to kind of go through those items real quick. The first one was related to will a borrower's PPP loan forgiveness amount pursuant to Section 1106 of the CARES Act and SBA's implementing rules and guidance be reduced if the borrower laid off an employee, offered to rehire the same employee, but the employee declined the offer. So this, Mark, has actually been a relatively big question in a number of the FAQs that we got in regards to what if I laid people off and I went to bring them back and they said they declined the offer to come back. So basically, the answer here is that the answer is no. That the SBA kind of looks at this situation is that that if you laid off an employee whom the borrower offered to rehire from the CARES Act loan forgiveness reduction, the interim final rule would specify that to qualify for this exception, the borrower must have made a good faith written offer to rehire, and the employee's rejection of that offer must be documented by the borrower. So basically, long and short of it is the SBA is saying that if you did lay somebody off, you want to go rehire them back, and they declined your offer, make sure you have the proper documentation in place that supports the fact that they're not willing to come back, and they'll allow that to be a change in your loan forgiveness in regards to your FTEs.
Yeah, because the one of the common concerns we heard was people are with the supplemental unemployment insurance available. People are sometimes making more money being unemployed, or maybe they're just scared to come back to work because they don't want to get sick, or maybe they have to take care of a family member. All legitimate things for everybody to consider. So employers were concerned, if I can't hire these people back, am I going to get dinged on the head count? So this was nice that they put that out there. But again, document. If you don't document it, it doesn't happen. So it specifically says written. An email will probably suffice for that. However, you have to make sure that you confirm that the person actually received the email, so that there's an email chain there, a virtual paper chain there, the trail there that says they got the offer and they refused it.
Yeah, exactly, Mark. And I think the other thing that's important to note here too is at the very end where it says employees and employers should be aware that employees who reject offers of a reemployment may forfeit their eligibility for continued unemployment compensation. That was another one of our questions that we got of, could you still be eligible for unemployment compensation? And again, documentation is critical here, because if you offered them the job, they declined it, they may put themselves in jeopardy of continued unemployment comp. So
that's right. And remember, it has to be the same salary and wages. Can't give them an offer to come back at half the pay and then document that they didn't take the job.
Exactly. Right. Let's go to the next question there, Mark. The question 41, it deals with seasonal employees, and it just says a seasonal employer elects to use a 12-week period between May 1, 2019 and September 15th of 2019 to calculate its maximum PPE loan amount under the interim final rules issued by Treasury on April 27th, make all the required certifications of the borrower's application form. So the answer there, again, is yes. And basically what the rules are saying here is that, the guidance changed where they said if you're a seasonal employer, you can now look at this time period between May 1 to September 15th, 2019, and then pick that 12-week period that makes the most sense for you to be able to calculate the maximum amount of your PPP loan. So it's when you're making that certification as to your need, your economic need, you have to look at that 12-week period that you picked to calculate your loan and say, based upon looking at that 12-week period, looking at the current climate conditions going into that 12-week period during this time, yes, I'm going to have an economic need for this Paycheck Protection Loan.
Seems pretty clear. Let's move on to the next question.
The next one that came out from the SBA, as Mark is getting us to the next question there. There you go. This one is related to nonprofit hospitals, and just basically saying, if you're a tax exempt nonprofit organization that's a hospital, can you qualify for a loan under the CARES Act? And basically what this is saying is yes. The SBA will treat the nonprofit hospital as if you are as a 501c3 organization, and therefore you can apply for a loan under the CARES Act.
All right, good.
Question 43. Now, question 43 dealt with, this is the question 43 is kind of a reminder of question 39, question 31, which just basically says that, borrower to review carefully your certification as a borrower and whether you really needed this money, and that, by the way, we're going to extend this repayment period from May 7th to May 14th that Mark talked about a little bit earlier. So we're going to give you that second bite at the apple, Mark, to make that decision of whether did you really need that money or not. You might not have needed it the first time, but we're going to give you another week to think about it. It's basically what's been said here.
Yeah, I love how we've had at least 3 now FAQs on this topic, which is 2 more FAQs than we've had on any other topic, and it's all the other topics where we actually needed the FAQs on.
Yes, absolutely. So again, just to reiterate the point, though, that you have to May 14th to make this decision finally if you want to maintain that money and keep it or not. Question 44 just dealt with some changes of how the SBA looks at affiliation rules, and that basically their answer to this affiliation rules for foreign employees of foreign or U.S. affiliates, as it just says, for purposes of the PPP for 500 or fewer employees size standard, an applicant must count all of its employees and employees of its U.S. and foreign affiliates. That's basically the bottom line for that. It's just another clarification on how the affiliation rules would work for foreign and U.S. affiliated companies.
So it's all employees, foreign or domestic. And also one thing that kind of flew under the radar, the SBA fairly early on came out and said this 500 or fewer employee number is not a hard and fast rule. Depending on the industry that you're in, your NAICS code, the SBA defines small business as by the number of employees and or your amount of revenue by NAICS code. So if you go in and do your NAICS code search, you might be under a 1,000 employee limit or 1,250. So it might not be just that hard and fast 500 employees.
Yeah, absolutely, Mark. I mean, especially if you're in the hospitality industry specifically, there's they look at it based upon location of your hotel or restaurant, and you don't have to aggregate all these organizations together under your franchise to figure out if you're at the 500 level or not. So
that's right.
Okay, and then the final FAQ updated question that the SBA put in there here just most recently. And this one just came out, I believe, on Friday, Mark. Question 45 here is an employer that repays its PPP loan by the safe harbor date of May 14th eligible for an employee retention credit? And the answer there is pretty simple, yes. So if you repay your PPP loan, as Mark said earlier, the SBA and Treasury kind of look at this as it never happened. So you can go back and take these employer retention credits, which we wrote an article on this a couple weeks ago about the employee retention credit. And quite honestly, it could be an option or alternative for organizations if you're not taking the PPP, because you get the full benefit of the wages up to $10,000 to offset against any types of payroll taxes, and then you could file for, if you have more wages up to that $10,000 in the payroll taxes, you can actually file for a refund. So it does put cash in your pocket pretty quickly. So it is another option out there outside of the PPP loan.
Yeah, this is one thing that might influence companies' decisions on whether or not to keep the PPP loan, because obviously the payroll protection loan got all the hype and all the coverage, but this is there lurking in the background that if either you have too many employees or you decide that you may not be able to make that certification that you actually needed the loan, this can help to put cash back in your pocket and help cover your payroll.
Yeah, so I would invite anybody to go out to our COVID-19 webpage and look at that article that was written a couple weeks ago about the employee retention credit. So outside of this, these are some of the FAQs that came back from the SBA. The SBA also just very recently, and very quietly too, Mark, I must say, it was kind of stealth-like at the middle of the night, kind of like that pay raise that our Senate and House did back in 2005, where they decided that for this economic injury disaster loan program, the initial requirements of this loan program were that you could get a loan up to $2 million. They cut that drastically here recently, where they cut the funding to that to be in a max loan of $150,000. So that's well over a 90% reduction in possible maximum loan amount. And then on top of that, Mark, they decided that, for this $10,000 that you can get as emergency money or grant money, well, now we're going to limit that to $1,000 per employee up to $10,000. So, if you're a large organization, it really doesn't matter. But if you're a small organization, only a couple people on payroll, you're going to be limited to just the amount of employees that you have for $1,000 per employee. And then the last thing they did is they said, we're going to limit applications going forward. It's just agricultural interests and agricultural organizations, because Congress's big push right now is making sure that there's enough stimulus money out there to support the agriculture industry. So if you didn't get your application in for your EIDL loan by now, you might be in trouble. So hopefully you got it in before the first round of money ran out on April 14th. But if you didn't, and you're not an agricultural interest, you might be in trouble and finding EIDL money.
Yeah, it is. We're seeing a common theme here that the SBA just kind of does whatever they want, which, maybe this is the right decision. I don't know. It would just be nice if there was a little more clarity, a little more official announcement of stuff, and maybe an explanation as to why. I mean, I'm guessing the explanation is just there's not enough money there, and they want to make sure everyone gets at least some money. And I did wonder when all this started, everyone running for EIDL loans in the very beginning, with the max being 2 million, how long that was going to last. But yeah, it's fun when you wake up every morning and there's new things like this happening that no one saw coming.
Absolutely, it's crazy. So I think we're actually on to our second polling question. So the second polling question is: do you agree with the decision made by some PA counties to move their counties yellow out of the governor's approval, without the governor's approval? So, knowing that's a big issue here in central Pennsylvania, seeing that Dauphin County and Lebanon County commissioners have already told the governor they're moving there to yellow on the 15th, but then the governor's saying that he's going to restrict any types of state and federal funding that would go to these counties if they don't follow the governor's approval. I know there's a lot of concern in regards to the health aspects of this, Mark. And Mark, being that you are yourself a first responder, being that you're a firefighter, I mean, how do you feel about this, Mark, and what do you think about this from the perspective of the first responders' point of view on this?
Honestly, as long as everybody, well, there's not a dramatic difference between red and yellow. So we're not talking, just all of a sudden we're just back to normal. So that's part of it. I don't see it having a huge effect. One, two, if everybody just continues to follow the guidelines of, you wear a mask, you're careful about social distancing, you wash your hands, you do all that stuff, I don't see it having a huge impact. I will say though, fire calls, response for emergency services across the board in central Pennsylvania in the fire service is way down because people aren't, nobody's driving. People are afraid to call 911 because they're afraid that if somebody shows up, they're going to get sick, et cetera, et cetera. So if we do open this up too fast from the first responder standpoint, the increasing call volume is going to put them at more risk of everything. So, but at the end of the day, like I said, there's not a dramatic difference between red and yellow, and hopefully everybody will follow the rules, follow the guidelines, and everybody will stay safe regardless. And at the end of the day too, I think we're only talking about maybe a week or two difference. I'm guessing Dauphin, Cumberland, maybe Lancaster would be a little later on. I'm guessing Dauphin, Cumberland, York, Lebanon would all be going to yellow, in a week or two anyway. So it's probably just a week or two sooner than was going to happen regardless.
Interesting results here. 54% say they don't agree. Interesting. So I would have thought actually you might have seen that the other way around, but that I think is kind of the sentiment of what we're hearing in the marketplace right now. It's really more of a 50-50 split between whether people agree with the counties or not. So let's go right into these FAQs. Again, Mark, you and I had a ton of them to answer. I mean, there was a lot. So, and we really appreciated all the questions because some of them really required us to really kind of really think through the details of whether that would make sense or not to be able to do what was asked in the FAQ or not. So, and we had to do a little bit of research on our end. So, but I do want to make sure we get this disclaimer out there, Mark, and that is, we're basing our answers based upon the knowledge that we have of the way the CARES Act is written in the language within the CARES Act. You will see in a lot of these answers that we're going to recommend that you discuss this with your lender, or further clarification needs to come from the SBA. So, some of the stuff is in black and white, some of it's very gray, and we do feel that there's probably still additional information needs to come from the SBA, of which the SBA has also said that they are going to be issuing further guidance relating to these final rules on how loan forgiveness is going to be reviewed. I think part of the reason why we haven't seen that yet is because I think they want to see how many organizations give money back between now and May 14th before we see further guidance. But that's just our conclusion on that at this point in time.
Yeah, and at the risk of beating a dead horse, this is our interpretation of the law and the guidance that the SBA has put out based on our understanding of the intent of everything. Now, every once in a while, there still could be some curveballs coming. The biggest curveball in the very beginning was the SBA saying 75% had to be used for payroll. That's nowhere in the law. That's not in the CARES Act. The SBA just arbitrarily decided 75%. I don't necessarily disagree. It just would have been nice, if they put that in the law so that we would know up front what they're looking for. So that's the first part. Any and all of these answers, we could be proven wrong literally tomorrow because the SBA could just come out and say, we're viewing this differently. This is what we're going to do. Second, McConley and Asbury, we are approving forgiveness on exactly 0 PPP loans. Your lender is going to be the one who's going to provide the forgiveness or approve the forgiveness. So we are telling clients, this is how we interpret it. This is how we recommend you doing the calculation. But if it is any kind of a gray area, you must go to your lender well ahead of time and say, do you agree with this calculation? So that you get in, so you don't have any surprises, because you don't want to wait until the last minute and then risk not having full loan forgiveness because the lender disagrees with the way that you did a calculation. As we all know, all loans above $2 million, the Treasury said they're going to be reviewed. So if you're less than $2 million, you still may be reviewed, but you're certainly not, at least on the radar initially. So it's entirely possible the only oversight here is with the lender, that the Treasury is never going to actually review anything. So if you can get the approval of your lender, in most cases, you're probably going to be good. So with all those disclaimers out of the way, let's start going through these. And if you want to follow along, we have our FAQ sheet out there on the internet at macpas.com/FAQs. You can go download that and follow along with us. We're going to jump around a little bit because we're going to try and get through as many of these as possible. And again, if you have questions, feel free to submit those. We're going to cover as many of them as possible. So,
without further ado, Mark, why don't you go ahead and start with the first one there? We're going to start, just real quick though, you know, as you go through the FAQ sheet, it is broken out between things like it's going to talk about payroll costs first, and it's going to talk about salary calculation, FTE calculation, the calculation for other costs. We're going to kind of go down through that. We'll probably limit our time in each area by about 10 minutes an area to be able to meet the 3 o'clock deadline hour. So without further ado, we'll let Mark go ahead and take the first question.
All right. Our salary, the first category is going to be payroll costs. So under payroll costs, are salary increases acceptable? Generally, yes, as long as they are documented and they are within what you would call the normal course of your business. So as we know, the calculation of the loan amount was your prior year, your 2019 total payroll costs divided by 12 multiplied times 2.5. Now, so that includes, you know, maybe a bonus that was paid at the end of the year that you normally wouldn't pay in April, May, or June of any given year. But by definition of that calculation, a portion of that is being allocated into this 8-week period. So we find it completely acceptable to say we're going to take, you know, 850 seconds of whatever the regular annual bonus would be and include that in here. Also, you can just say, hey, we do salary increases June 1. And this is going to be, we're going to include a portion of that in with this pay. So as long as it's documented, consistent, and reasonable, we see no reason why that would not be okay.
Absolutely, Mark. And you know, Mark, just to piggyback on that, if you go down a couple questions there, it talks about hazard pay and overtime pay for essential services to be carried out. That also would be considered eligible payroll costs if it's something that you have to do to keep staff employed to perform services, which could be typical overtime to perform the service, or it is a hazard pay type of situation. That also payroll costs would be an eligible payroll cost as long as it's within a reasonable, as long as it's reasonable per se.
Right. So sticking with payroll costs, how do we determine allowable amounts of loan forgiveness for payments to employees who in excess of $100,000 annualized? So as with the same with the calculation, any payments that would be, if annualized, would be above $100,000 max, that is not eligible to be included in the loan forgiveness amount. You can go over the $100,000 for employee benefits, health insurance, contributions to a retirement program, but cash compensation, that kind of base salary, annualized, you cannot include amounts that would take you over $100,000 for an employee.
Yeah. So another good question that came in was related to the calculation itself, being that it's 2.5 times the payroll cost, but the way the payroll calculation, Mark, works is it's 75% of the payroll. And you know, how am I going to actually use 2.5 times the payroll cost when I'm limited to 75% of it for the actual forgiveness piece? So unfortunately, if you're an organization that is heavy payroll and you don't really have any other costs like rent, utilities, you know, covered debt, covered interest on debt, unfortunately, Mark, that's just the way the mechanics of the calculation work. I mean, you're going to be in a situation where you might be in a situation where you have to pay back some of that loan or term out that remaining piece of the loan for the next 2 years, just because of the mechanics of the way the calculation works.
Yeah, and I think again we go back to this idea that not getting full loan forgiveness is this really terrible thing. It's not. It's totally fine. You just pay it back. And I think the SBA and the Treasury would come back and say, well, you didn't have to take the whole loan. That's what you were eligible for, but you didn't have to take all of that. So that's fine. No harm, no foul. You just, you know, pay some of it back. Or as Dave said, you just term it out over the term of the loan. I mean, 2 years. with a minimum 6-month deferral on your first payment at a 1% interest rate, I mean, I would take that.
Yeah, absolutely. It's just unfortunate that, the way the SBA set the 2.5 multiplier up was to take into account the fact that, yes, it'd be 8 weeks of payroll, plus we were going to also make sure that you had some ability to cover rent, utilities, and interest on debt. So if you don't have those other items, it would be difficult to use up all that money. Mark, the next couple questions are actually related to taxes. The first question just talks about what exactly are state and local taxes assessed? Is it LST, PAUC, employer and employee withholdings? So real quick answer to that is it has nothing to do with employer or employee withholding amounts such as state taxes or local taxes. It has everything to do with anything that you paid that is related to the employee, such as if there is unemployment compensation assessment that you would have in your number, that you would pick that up. So it would not be LST, it would not be local earned income tax, it would not be state taxes. It's going to be any of those taxes that a typical employer is going to pay that's related to the employee, such as unemployment.
Yep. Yeah, we don't see this being a huge number.
Yeah, absolutely.
So.
And then the other question there below there too, Mark, just talks about the deferral process of your FICA taxes. So the way the rules are written for the PPP, Mark, is that it says that you can defer your FICA taxes during the time period that you have the PPP loan up to loan forgiveness. And the way the deferral works, Mark, and correct me if I'm wrong, is that you would be able to defer 50% of that FICA tax payment into 2021 and the other 50% into 2022. So, but it would only be for the time period of the PPP loan up to loan forgiveness.
Correct. So all your wages paid, the taxes associated with those wages, you can defer those taxes for wages paid up until the point in time when the loan is forgiven. Once the loan is forgiven, that deferral stops. You can still defer those amounts, but any wages paid after that point, you can no longer defer the FICA taxes for those.
Right. I stole your thunder on the last couple of questions, Mark. I'll let you jump in here and take a couple here.
That's okay, Dave. Next question, life insurance premiums, long-term disability. So the included in payroll costs are health insurance benefits. We see nothing in the CARES Act or the SBA guidance that would suggest that life insurance premiums or long-term disability payments made by the employer would qualify. However, be careful, because a lot of times what happens is maybe a life insurance premium that's paid by the employer is included in the W-2 of the employee. That is just like cash wages that the employee then chose to spend on life insurance. So you can include it. It's just included as wages. It's not included as life insurance.
Yeah, Mark, that's a great point too. I had somebody reach out to me and say that when they applied for their loan, they actually put the life insurance premiums in the loan amount, and the bank approved it. So without knowing any further about that, I've thought that maybe the bank is looking at that from the perspective of those life insurance premiums are probably part of wages, and they're looking at that as part of the wages.
Yep, and along similar lines, workers' compensation insurance not includable in payroll costs.
Right. Yeah, that is a common theme throughout here, Mark, is what about workers' compensation insurance? There's nowhere anywhere in the Act that we've seen that workers' compensation insurance is included. And I go back, Mark, to the intent of the Act. The intent of the Act is to cover payroll costs and other operating costs. And payroll costs to me are still relatively, clear in regards to its wages, salaries, tips, cash compensation, and then anything that you would pay that would be wage-like for an employee, such as healthcare benefits, 401k match, things of that nature.
That's right. And everything the employee is getting a direct benefit for immediately.
Right. Mark, what about guaranteed payments to partners? How about increase? The question is, how about increased guaranteed payments to get there, to be able to meet the $100,000 of to meet that $100,000 annualized amount?
Yeah, so in contrast with the way the law was written, guaranteed payments are included as payroll costs, both on the application to calculate the loan amount and for forgivable payroll costs. And this is similar to the raises, the salary and wage raises that we talked about earlier. We see no reason why you wouldn't be able to increase guaranteed payments. You just have to kind of follow the same guidelines of, is it reasonable? Do you have a good reason for doing that? Because anything that smells like you're just stuffing payroll in there just to get loan forgiveness probably won't be looked upon kindly. But again, most lenders are going to have different interpretations of this. So you're doing yourself a disservice if you don't check with them first. So yeah, guaranteed payments included as payroll costs. You can increase guaranteed payments. Reminder, if you go above the $100,000 annualized amount, that is not allowed. So up until the $100,000 limit, we see no reason why not.
Right. Another question in here, Mark, just relates to bonuses. Are bonuses included in gross wages for loan forgiveness calculations? So this is another common theme that we see throughout here, is this idea of additional compensation to be paid. And you know, I think our look at this is that can bonuses qualify? Yes, but we would say that, you know, there's bonuses because it is compensation, it's cash compensation, Mark, right? But I would think that you need to clearly document why you did the bonus. Is it a bonus that's within the typical normal course of business? Is it a typically scheduled bonus? To do a very large bonus out of the blue almost in order to try to get loan forgiveness might raise red flags or might raise questions. So you should look at that from the perspective of, you know, the reason for the bonus, why I did the bonus. You might have had to do the bonus, Mark, because, you know, you have an issue with just retention of employees because of the environment that you're in. So you're like, I have to do a pay bonus in order just to continue to keep my salary and my staff and to continue to keep my FTE counts. That to me would be reasonable. But if you're just doing a bonus because you got this money and you're doing this big bonus, that might raise some questions.
Yeah, we saw some people coming up with interesting scenarios of questions to say, you know, well, what if I hire like my brother? What if I hire my neighbor and pay them, put them on payroll just to use up the money because I can't get people to come back, or they won't come back, or I have no work for them to do. So why would I be paying them? And then as long as I either keep headcount flat or then hire everybody back before June 30th, I get it all forgiven. You know, I guess, sure, maybe you meet the letter of the law. I don't think you meet the spirit of the law. And I think you would have some concerns. Should there be a review, and should the bank say, hey, I just couldn't help but notice that your brother's now on payroll and he was never on payroll before. What happened there? And maybe you do have a legitimate reason that there was work to be done and nobody else would do it, and so your brother was available, so you hired him. You just got to make sure it's legit. Right.
Some other questions in here, Mark, about HSA contributions. I would say yes to HSA contribution. It is a qualified expense there. I would say also 403B and 401k contributions, making those instead of a bonus. Again, I would think that would probably be a reasonable, legit expense as well, if it's you know, if it's within reason. A couple other things down here that we saw is payroll processing fees. Nowhere do I see anywhere that it says that payroll processing fees would be an allowable expense.
That's right. Yeah, if it's not cash going to an employee, then you need to question it. Is it mortgage? Is it utility, mortgage interest? Is it utilities? If it's not, or rent, if it's not, then it's probably not includable.
Right.
So if you're following along at home, we're a bunch of these questions are minor variations on the stuff we've already covered. I'm scrolling through here to make sure nothing's jumping out at me. One question was, if you don't meet the 75% payroll cost amount, do you get a ratable amount of forgiveness? Yes. If you only spend 70% on payroll, then you're going to get some forgiveness. You're just not going to get the whole forgiveness.
Yeah, absolutely. We got a couple other questions in here too about, can I use it all for payroll? versus just up to the 75%. Yes, it can use 100% of it for payroll, no questions asked. Severance pay, there's a question here about severance pay. Yes, severance pay is considered a allowance for separation. That's part of the calculation as well, that you can include in there to your loan forgiveness amount. You would have already included it for the loan, so it would have been includable for loan forgiveness as well.
Yeah, I think that's a win if you can use it all for payroll.
Yeah.
There are a lot of companies who you base your payroll cost, you base the loan amount on 2019 numbers, but then the first couple months of 2020, you might have hired 10 or 20% more people. So you can continue to use that for payroll. That's great. Nothing wrong with that. Then kind of you don't have anything to worry about. You're getting it all forgiven.
Just going a lot of the payroll questions are similar, Mark, with a lot of the similar same theme that we've covered there. Just looking down through here, can we pay bonuses or overtime as part of the loan? We talked about that as being, yes, that's reasonable. You can do that. Making discretionary contributions to 401k plans. Yes, that would be considered includable if 401k plan is considered a qualified plan for the payroll cost calculation. What if employees are voluntarily leaving? We are not letting them go. So that's a good question, Mark. I mean, if they're voluntarily leaving, I think it goes back to almost the most recent SBA FAQ, where it talks about employees that are being offered to come back and they're not coming back. This is a different story of where they're voluntarily leaving. So, or looks like further guidance on that matter in regards to voluntary leaving might be needed by the SBA. But we would say that we would think that if the SBA's guidance that's going to come out here is going to say if you have people that are voluntarily leaving, that's probably going to get adjusted within the calculation somehow. But again, I think further guidance on that is probably needed by the SBA at this point.
Yeah, the latest FAQ, where if you made a written offer of employment to a person and they refused, leads me to believe that if they're leaving voluntarily and if you can document that their job was still here for them, you're not going to get dinged on the headcount, and you might have an issue with loan forgiveness just because you have money that wasn't used for payroll. But again, back to the thing of if it's not used for what it's supposed to be used for, yeah, you might have to pay it back, but there's nothing wrong with that.
Right. Just looking down through here, Mark, a little bit more. I'm down on page 5 of this of the FAQ right now. Good question here that came up, Mark, is are you allowed to use money for back pay? So, I think the answer to that is real simple. That the intent of the CARES Act is that it's going to cover payroll and payroll-related costs that have that you've incurred and paid during the 8-week covered period. So the question of back pay, I would think would be one that I would be cautious on making back pay payments, because if the back pay is for services that occurred in March and you laid those people off and now you brought them back under the 8-week covered period, there might be some questions about making that payment of payroll from a month ago versus what is due inside that 8-week covered period to be paid.
Yeah, if it's a question of doubling up payment, meaning you're going to pay someone twice what you normally would have paid them during this 8-week period, I think that's a problem. If it's a question of, well, we didn't pay anybody for 2 payroll cycles before we got the loan, presumably if you couldn't pay them then, it's because you didn't have any work for them to do, you didn't have any revenue coming in, so presumably then you wouldn't be able to pay them now either. And they're not doing any work right now, so you're just paying them for right now. You're not paying them for back pay. Again, as long as you're just paying them the regular wages, you're not doubling up.
Right, exactly. Another question in here about temporary employees considered payroll costs. Again, temporary employees are not considered part of your payroll costs. They're considered independent contractors. Those independent contractors that independent contracting organization would be able to file for their own PPP loan, or those independent contractors would be. So temp employees that are not running through your payroll, but you're paying them through a temp agency like an Aerotech, clearly would not be part of the payroll cost.
And they should not have been included in the loan calculation either.
Yeah,
so.
Exactly.
Should we move on to
I think so, because looking at the rest of the payroll questions, Mark, I think you know, we've hit them pretty hard. Things like payroll tax forgiveness. You know, there's a lot of questions here about life insurance policies and forgiveness and what qualifies as health insurance. And I think we hit that pretty good, Mark. So I think let's go ahead and move on to the salary calculation. That seems to be another big area of discussion.
Yeah, and the biggest issue giving everyone heartburn for the salary calculation is just the way it's worded is just horrible in the law. Because legitimate question is, the law says you have to pay somebody the same thing that you paid them during Q1 of 2020. Well, I mean, I'm not an accountant or anything, but 8 weeks is shorter than Q1. So how do you maintain that level when you're just paying them over 8 weeks as opposed to what you paid them for 3 months? In my mind, there's no way that what they mean by this is anything other than an annualized rate. So during Q1, if someone's salary was $50,000 a year, Q1 you would have paid them $12,500. During the 8-week covered period, I would say you don't need to pay them $12,500. You need to pay them $12,500 divided by, well, I guess annualized to 50,000 divided by 52 multiplied times 8, whatever that number is. It simply doesn't make sense that you would have to give somebody a raise to get their wages back up to what they were actually paid during a longer time period. Again, it shocks the conscience to think that they would not clarify this, but you know, who knows? But that's the way we're seeing it.
Yeah, there's a number of that question is prevalent throughout the salary calculation, Mark. I mean, again, you know, that's just the way it's written. I mean, that's the way the rules are written, and I would believe that the SBA is going to come out with further guidance on how to look at that 8-week covered period versus the quote unquote first quarter of 2020 payroll. So wait and see what comes out there from the SBA, but that's just the way the guidance reads right now.
Right. So, and again, this is a common theme. There's different variances of it, but then, you know, we have the question: what if someone halfway through the 8-week period quits? So now, does their wages go down as compared to Q1? Again, I don't believe so. I think you would look at it on an annualized basis, and you would say, well, they worked for 4 weeks, and during those 4 weeks, they were paid at the same rate as they were paid during Q1. It's just a smaller number because it's only for 4 weeks. Your headcount test, you might have a problem with, but I don't see a problem with the salary test because, again, the idea of the salary test was to make sure you paid people the same rate that you paid them during Q1. You do get 25% grace area there or whatever. But the idea is that you're not cutting people's pay too much during the 8-week period. So I think you would be fine, again, as long as it's under the same annualized rate.
Right. Just looking down through here, I mean, a lot of the questions are all centered around this this variance between the 8-week period and 12-week period, Mark. Covered employee headcount. What if employee is in the hospital, unable to work for commission? Do you still pay? That's a good question there. I mean, the way we looked at that is we said, you know, clearly further guidance probably needed on that. And probably that's more of a disability, long-term disability question that might be more managed actually under federal and state law matters in regards to how that compensation is dictated for a hospitalized employee. But I mean, that's a really good question, Mark. I mean, like, what if the person's in the hospital? I mean, what do you do?
I don't know the answer. My view is kind of if they would have been working had they not been in the hospital. Again, legal issues aside of short-term disability, long-term disability, whatever. If the idea is to get cash into people's hands, if you can pay them, there's lots of employers out there who are paying employees who can't work, whether because there's no work or whatever. So if it comes down to either paying them or repaying the loan, I don't see a problem paying them.
Right. All right, just paging down through here, Mark. Any of these questions you want to try to jump in on, Mark? Anything that you see that is kind of I see a lot of the same questions.
Yeah, the other common theme here is, you know, how do we, because we have 8 weeks of payroll, but if you only do payroll on the 15th and 31st of each month, then you're going to miss a payroll cycle. because that's more than 8 weeks. So can you do a special payroll? Yeah, I see no reason why not, as long as the services that you're deemed to have them doing, whether they're actually doing them or not, as long as those have been incurred, you should be fine. The way the law reads is costs incurred and payments made during the 8-week covered period. A very liberal reading of that tells me if the costs were incurred or the payments were made, then you're fine either way. Meaning you could make a payment after the end of the 8-week period and count that. However, we're cautioning people to, out of an abundance of caution, meet both tests. Until the SBA tells us differently, meet both the incurred and payments made tests.
Yeah, absolutely, Mark. I mean, I kind of look at this. I kind of look at the whole act in regards to just the overall intent. The overall intent is we want to make sure that you have cash available to pay payroll and payroll-related costs during that 8-week covered period. So, you know, you might have a situation with your payroll just because of the way the pay dates fall. I kind of look at it from the perspective of, Mark, that as long as you have 8 weeks of payroll in there, that's the key here. You know what I mean? So right. The services might have been actually incurred the prior week, but as long as you got 8 weeks of payroll in that 8-week payroll period, that's kind of the key here, is that you're making 8 weeks of payroll. Or if it's rent, which we'll talk about here in a little bit, you know, it's like you got 8 weeks of, or 2 months of rent in there. You don't have 3 months of rent or 5 months of rent. You got 2 months of incurred costs that occurred and you paid in that time period. That's the whole intent of the act.
Right.
Yeah.
Yeah, and again, well, not again, because we haven't really covered this. You know, people have been asking, well, what if somebody during Q1 worked a ton of overtime and they got paid way more than we're going to pay them during this 8-week period because we either don't have the OT or we don't have any work for them to do? Again, I would go back to the rate of pay. So if they were making $12 an hour during Q1, they just happen to work a lot more hours. But then during this 8-week period, you say, we don't have any work for you to do, but we're going to pay you for 40 hours, as if you had worked 40 hours. As long as you're paying them $12 an hour, our understanding is you should be fine.
Right. Okay. Paging down here. I mean, most of these salary calculation questions, Mark, are really centered around the same kind of concepts that we just talked about. Yep. You can talk about, we talked about replacement headcount. We talked about bonuses being paid. We talked about the pay period being the difference in the 8 and the 12-week period. Why don't we move ahead, Mark, I think, and since it's about 12:51 here already, let's move ahead and go to the headcount and FTE calculations.
All right. So first question, what if I have a reduction in headcount but need to pay each FTE more money in order to bring them back? So there are two separate tests. You have the FTE test, and it's possible to pass one test and not the other. If you have to make a choice and to fail one test or the other, it's most likely you're most likely much better off to fail the salary test for two reasons. One, if you have 20 employees and if you have 20 FTEs and you go from 20 to 19, so you have a decrease in FTE, that's a 5% haircut on your forgiveness. Whereas if you drop one person's salary to less than 75%, it's most likely a much smaller dollar amount that you're going to lose forgiveness on. So the FTE test is probably the more important one to pass. And also, again, you have until June 30th to restore your FTEs. So even if you don't get it during the 8-week period, as long as you can hire that person back before June 30th, you should be good.
Yeah, I mean, that seems to be another theme throughout here too. Like, hey, in my 8-week period, what if I don't, at the end of my 8-week period, I don't hit my headcount number, but I have that headcount restored by June 30th. So the way the SBA has written this rule is they give you that second chance. We'll say that if you don't get to that FTE count by the time of your own forgiveness, as long as that FTE count is reestablished and salary costs are reestablished by June 30th, you do qualify for loan forgiveness. So just looking down through here, Mark. This is my favorite question of all time.
it sounds funny, but it's accurate considering what's going on. The question is, if you're paying an hourly employee to do nothing, how many hours did they work? It's like, how much wood could a woodchuck chuck if a woodchuck could chuck wood? Again, I don't know, other than to just say you back into the number. So if you got a payroll protection loan for $100,000, you need to pay $75,000 of that out in payroll to X number of employees. And so they all generally work the same amount of hours, but there's no work for them to do. Split it, you pay what you would normally pay them during a kind of a generic 8-week period, and divide that by by whatever rate of pay you were paying them in Q1. There's your answer. That's how many hours they worked. But that's just one of my favorite ones, and is a legitimate common question.
Yeah. Another good question that comes out there, Mark, is about part-time employees and how do you calculate these part-time employees? So, the big thing with part-time employees in determining this full-time equivalent is that you have to look at your wages and hours based on this 30-hour work week, because that is really what the SBA is working from in regards to full-time and part-time employees. And the 30-hour work week comes from the ACA Act, if I'm correct there, Mark, right? It comes from the Affordable Care Act. And that seems to be where this 30-hour work week's coming from. So at full-time equivalents are considered anybody that's worked 30 or more hours a week. That would be considered a full-time equivalent. And if you've worked anything less than 30 hours a week, that's where you go into this calculation of how many, if employee X worked 24 hours, employee Y worked 24 hours, and employee Z worked 22 hours, how many FTEs is that? Well, you would have to actually take those, all three of those hours, add them up, divide it by 30, and that will give you what your FTE is for those three part-time employees. And that seems to be a very common calculation throughout here in regards to how do you calculate the FTE.
Yep, so we have two buckets. We have full-time employees, not to be confused with full-time equivalent. You have full-time employees. Those are people who regularly work more than 30 hours. So whether they work 30 hours a week or 100 hours a week, they're one full-time employee. And then you have the FTEs. Well, then you have part-time employees who regularly do not work more than 30 hours a week. So that's where you would do the calculation Dave just said, and divide that by 30. Add that to your full-time employee number to get your total FTEs. Now, some people have said, are we locked into this 30-hour-a-week requirement? No. There's nothing in the Act that says how you have to calculate it. We're simply using 30 hours a week because that's what's in the Affordable Care Act. I've run 100 different variations of this. Whether you use 40 hours a week or 30 hours a week, as long as you use them both for the numerator and the denominator, the difference is negligible. So as long as you're consistent in the calculation, you're most likely going to arrive at a similar answer.
Right, exactly. The other thing that came up too, Mark, is just related to, what was the question I was looking at here? What happens if you have full-time employment during the 8-week measurement period, but you have to furlough in between that and June 30th? Will your forgiveness be impacted? Good question. So let's just say that you go from, your time period runs from April 15th to June 12th, I think would be your 8-week period, and you have a headcount number at June 12th. What if you have to furlough between that time and June 30th? Is there a loan forgiveness issue between that June 12th to June 30th timeframe?
So no, I mean, there's a whole bunch of businesses that are shut down right now. They have no work to do, and nothing's going to magically change at the end of this 8-week period. So you pay them during the 8-week period, and then once the money runs out, if you don't have any work for them to do, if you don't have any money to pay them, what are you supposed to do? I mean, there's a lot of businesses that are shuttered that are never coming back. So as sad and unfortunate as it is, there's nothing in here that says you would lose loan forgiveness if you then have to lay people off after the end of the 8-week period.
Yeah, and that seems to be a big question too right now of, I got this money for the next 8 weeks. I can cover my payroll to the next 8 weeks. I'm not sure what the future holds. if I have to terminate people or lay people off, is that going to impact my loan forgiveness? And again, as Mark just said, it doesn't appear as if that would be the case, as long as you've maintained the integrity of that 8-week period with payroll and headcount. Whatever happens after that 8-week period, it's the business has to make business decisions.
That's right. So I see we're at 2:59. We're going to jump ahead to the final polling question. So those of you who have stuck with us for this long, we have our final polling question. Dave loves to do this to me. Which of the following were Pennsylvania governors?
We have Richard Thornburg, James Beaver. You have Mark Heath. You have both A and B, or both A and C. So let's see what the responses are here, Mark. I'd like to throw you in there, Mark.
I appreciate it.
Give everybody about another 20 seconds or so to answer this question, and then what we're going to do is we're going to move out of the headcount and the FTE, and we're going to go into the other 3 or 4 areas that have much less in the way of questions, and we'll get through those as quickly as possible, and hopefully we can be done here by around 3:15. All right, let's see what what the answers are. Okay, yes. So the answer is actually A and B. So Dick Thornburg was governor from 1980 or 1978 to 1986. James Beaver was actually a governor back in the 1800s, and you might recognize the name because Beaver Stadium at Penn State's actually named after James Beaver.
Oh, I didn't know that.
2% of the people actually picked you, Mark. That's
I'll tell
awesome.
you what, I can say I am glad I'm not governor.
So, all right. Well, let's keep moving on here.
One last thing on the head count. I got us to a blank screen. Hold on. It's important to differentiate between head count and FTE. On the application for the loan, you used head count. Head count is total number of employees, whether they work 1 hour a week or 75 hours a week. That if you have one person who works 1 hour a week, one person who works 75 hours a week, you have 2 employees. For FTE, you have to do the calculation, and by definition, as long as you have at least some part-time employees, your FTE number is always going to be less than your headcount number. So those are 2 different definitions used for 2 different things.
Right. Absolutely. Okay. I'll tell you what, Mark. Let's just for purposes of time, because really a lot of it. What I would recommend everybody do is on our website we have a fact sheet that you can take and print it out if you'd like. It's about 3 or 4 pages, and it goes through this whole FTE and headcount calculation in regards to loan forgiveness. It also goes through a specific calculation around the salary calculation for loan forgiveness. We would recommend that you go on to our website and pull that down. I think that's a really helpful piece of material that you can have at your disposal on your desk as you're looking at your organization and how those calculations work. We can also, from here at McConnelly and Asbury, if you're interested, you can contact us and we can help you through these calculations as well. I'll be more than happy to do that with anybody who needs assistance. So let's just go through some other questions here under other costs. So other costs would be things like rent, utilities, interest. They were all the items that are considered part of the 25% or less calculation for loan forgiveness. So just go over a couple things here, Mark. Can compensation include vehicle lease payments and gasoline, diesel expenses for company vehicles in the 25%? So based upon the way the rules are written, Mark, in the interim final rule that was issued in 414, it talks about the use of loan proceeds for vehicles, and those vehicles would be any types of interest costs on the vehicle lease or on the vehicle payment. It would also be gas for the vehicle. It talked about that in there as well. The interesting part about that, Mark, is that guidance is actually under a question that relates to if you are a sole proprietor and you're filing for a PPP loan, what costs would qualify? So a lot of people have taken the position that because it's actually in the interim final rule, whether it's for a sole proprietor or not, those costs should be included and allowed. But it's interesting that it was under that specific question about sole proprietors.
Yeah, and that does give me pause on that one. If you need that for loan forgiveness, check with your lender. If you don't need it for loan forgiveness, I would say don't use it.
Yeah, I tend to agree with you, Mark. I mean, it's because I don't know why they would have just isolated that under that question and answer for a sole proprietor, and it wasn't included with other utility costs
Right.
within the act itself. But it is in there. There is some guidance in there that says that the gas and interest on your car would be what, you know, if you use the car. But there's a lot of questions around, like, what if I have a fleet of vehicles that I'm using? The diesel count? Can the gasoline for the tractor trailers count? You know, that there's some gray area there. So I would just be cautious, and I would probably discuss that over with your lender.
The real estate taxes is one we see regularly, and actually I think Dave and I might disagree on this one. I'm a tax guy, so when I read rules, I have a very strict reading of them. I see nowhere in the CARES Act that says real estate taxes, even if they're included in CAM, are forgivable costs. And the Act says rent. It doesn't say common area maintenance, even if common area maintenance is included in your lease. I'm guessing your lease says you pay this much per square foot per year or per month or whatever, and then you pay CAM on top of that. I'm a pretty black and white guy. I look at it and I say, if they wanted to include CAM, they would have included CAM. It just says rent.
Yeah, I don't know if I disagree with you, Mark. I think that the best thing you could possibly do, though, is if CAM charges and real estate taxes are all lumped into your rent, you probably need to have that broken out somehow. From the landlord, so you can identify what portion of that is rent under the utility piece of it, and what is not.
Yeah, I would agree. There's no reason to not, get aggressive with it and find out of that CAM how much is for utilities and include that. But again, this falls into pretty much all of these fall into the bucket of if you need it for loan forgiveness, unless it's a clear-cut utility, mortgage interest, or square footage rent. Unless it's very clear-cut, if you don't need it, don't use it. If it's anywhere in a gray area and you need it for loan forgiveness, then check with your lender.
Another common one that comes up, Mark, it sounds not like it's not a big deal, but if you think about it, trash removal. Is trash removal considered a utility or not a utility? I mean, I guess you could kind of look at that both ways. I mean,
I would say, trash removal businesses are public utilities, right?
I would think so.
I would call it a utility.
Yeah, I mean, so it's an interesting one though, because some people might not look at that as a utility, but I look at it the same way as you. I look at it kind of similar to you, Mark, and that is, when I think about utilities, I think about electric, gas, phone, cable costs, and trash, because that's all kind of, to me, part of the operations of your business. It's all part of the utilities of your business. So, but again, I think from a trash removal perspective, that might be one that you might want to get clarification on from your lender, whether they're going to take that as forgivable or not. Let's see what else we got here, Mark, as we go down this list.
I'm starting now to look at the questions that have come in during the webinar to see if there's anything new that we haven't covered yet. Someone asked the question, to whom do I have to certify that I actually needed the loan? That's as part of the loan forgiveness. When you apply for loan forgiveness with your lender, you have to make that certification that you actually needed the loan. Another common question is, when do we apply for loan forgiveness? Again, check with your lender to see what they're doing on that. But the lender has 60 days to approve the loan forgiveness, and but you have the first payment is only deferred 6 months. So if you got your loan funded on May 1st, you have until your first loan payment would then be due on December 1st, I guess. And so, but you want to give them 60 days to at least 60 days to approve the loan. I would say as soon as the 8-week period is up, or after the June 30th date is up, if you need to restore headcount or salaries, I would get that application in as soon as possible. But there is no scripted date to get it in. They just have 60 days to decide, so you want to make sure you give them at least 60 days and or as much time as possible before that first payment would be due.
Yeah, Mark, so that's a good point. I read an article actually this morning too, Mark, that talked about some banks will actually talking about starting to accept applications or requests for loan forgiveness in the 7-week period. So it'd be the week before, it would be 1 week before the loan is actually complete. So they would accept the application, and then you would have to complete the 8-week period, and then you would have to start giving the information. So I think maybe the banks are doing that because they're looking at the overwhelming amount of applications they're to get for loan forgiveness, in that they would rather start the process of the general process of just paper moving the application through the process, as soon as possible. So some of them are actually opening up the request for forgiveness a week in advance. So I would say you probably need to talk that over with your bank on how your bank's going to handle loan forgiveness.
Yep.
Mark, just looking down through here, there's some questions on the sole proprietor side we might want to just address real quick. Can I use the PPP loan to pay myself back for the last 7 or 8 weeks of continually paying my employees? That's a great question. So, if you're a sole proprietor, you filed for this PPP loan, and typically it's considered wage replacement in accordance with the way the Act is reading. So you would take that money that you received, and you would determine from what came off of your Schedule C, and that is going to be your wage replacement that you're going to pay yourself over that 8-week period. That seemed to be pretty simple, and the way it works is that you're going to take that Schedule C, you're going to divide whatever that number was for 2019, you're going to divide that by 52, multiply it by 8, and that's going to be your what they call wage replacement for that 8-week period.
So if I'm reading this correctly, this is one thing I've not been too involved on the sole proprietor side of things, but if I read this correctly, so if I have a Schedule C from 2019 where all I did was I just provided services, let's say virtually, whatever, I didn't have any expenses, and I just get payments via 1099 from my clients. So my loan amount would have been my total 2019 1099 income divided by 12 multiplied times 2.5. But then my owner's compensation replacement payments are limited to 8/52 of that number, which is less than dividing it by 12, multiplying it times 2.5. So is it impossible for me to get full loan forgiveness?
Yeah, that's a great question, Mark. I mean, the way the calculation works right now is it might be. In fact, we have a common client, Mark, that we know very well, and she's kind of in the same scenario, the same boat. And that was she got her loan based upon what was on her Schedule C, and when you look at what that loan amount was and you do this calculation of the 8/52, that is written in the interim final rules on April 14th. She has no other costs to apply money against. So the question is, is she going to have to pay some of this back now because she got a loan for $20,000, but she can only really spend 15 of it?
Right. And again, not the worst thing in the world. You're just not getting as much of a benefit as you thought you were.
Right.
So we're coming to the end now. There's one last thing I just want to touch on quick. The IRS did come out and say the expenses paid with the loan proceeds will not be deductible for tax purposes. So it kind of puts you back in the same spot as if they just wouldn't have made the loan forgiveness non-taxable. So it's a bad answer. It's still a win because you're still getting a decent amount of money that you don't have to pay back. You're just gonna have to pay tax on it. Obviously, there's 100 other factors that come into play as to determine how much tax you're gonna have to pay. But so it's still a win. It's still very helpful for your business, but you may have a tax liability. However, senators on both sides of the aisle have come out and said this was not the intent. We need to fix this. Now, will they actually fix it? I don't know. It just depends, what their tolerance is for this. But right now, it is taxable, or at least the expenses are non-deductible. So keep that in mind.
Yeah, Mark, just two other common themes as I look through the rest of the FAQ is one, under the EIDL loan, if you did get a $10,000 disaster grant forwarded to you, the proceeds from that advance on that EIDL will be deducted from the loan forgiveness amount of the PPP. So keep that in mind. That's written into the act specifically that that grant is a grant. You're literally getting that paid to you through the EIDL. The other thing too, Mark, just to clarify for everybody's purposes again, if you look under our accounting and tax questions here, a lot of the questions here relate to is forgiveness based on cash or accrual. So going back to the intent of the act states that if the services were incurred and paid for during the period under the 8-week covered period, that's how forgiveness is looked at. So looking at cost from an accrual basis is probably not the correct way to look at it. You got to look at things as to what has been paid during that 8-week period, and has the services been incurred during that 8-week period, or did you at least have 8 weeks of covered costs paid for during that period?
Yeah, that's right. Just remember, if you can, try and keep it simple. Make the payments for services that have been incurred. And our general opinion is that you should be good.
And the final thing too, Mark, just real quick, is about prepayment of costs, prepayment of rent, prepayment of utilities, prepayment of profit sharing. Again, you got to look at it from the perspective of did you actually incur the costs during that 8-week period, or did you have 8 weeks of or do you have at least 8 weeks of costs that you're paying for during that period? So prepaying rent, if you've already had two periods of rent already in there and you're prepaying a third period of rent in that 8-week period, that's probably not covered because you now have 3 months of rent inside of a 2-month period. Same thing with utilities. You want to make sure that your payments match the time period. So if you have 8 weeks of payments in an 8-week time period.
That's right. All right, Dave, if you don't have anything else pressing for us, I would like to, on behalf of McConley and Asbury, thank everyone for joining us for the webinar. If you have any follow-up questions that you'd like us to address, please let us know. You can also visit our COVID-19 Resource Center on our website at macpas.com. A recap will be posted as soon as we can get it up and ready. And for those of you who requested CPE, those certificates will be sent out in the next few weeks. We hope all of you stay safe and healthy, and you have a wonderful rest of your week.